All right, what's good, boys? Hope you're enjoying the order flow bootcamp. So in this video, we're going to talk about probably the most important aspect of trading overall, and I would say that is risk management. So I'm going to give you guys a rundown on risk management, what it is, what you should be risking per trade on your account based on your account size, based on if it's a live account, a funded account, and that's pretty much what we're going to talk about this whole video. So let's just get right into it. Before we get into it, most of you guys are not subscribed. If you guys are getting value out of my channel, please subscribe, like the video. Obviously, if you want to join the order flow Discord, it's free. It's in the description. Let's hop right into Miro real quick and talk about risk management. So I already said it twice, but risk management is definitely the most important part of trading, hands down. So what is risk management? Obviously, the name speaks for itself. It is how you are going to manage your risk. What are you going to risk per trade? What are you going to risk per day? Potentially on a longer time frame, maybe even per week, per month, if you really want to think about it. I don't think about it like that, but what risk management does is it makes sure that you have a lower chance of blowing your account, and it's going to allow you to maximize the amount of profit you can take out of a trade based on how much risk you take. So let's just get right into the basics, and I'll just start drawing stuff out for you guys as I like to do. So since everybody's primarily using funded accounts, I'm going to start out by talking about funded accounts. So let's just say you have a 50K account with the prop firm. Generally speaking, you are going to be allowed between $2,000 to $2,500 worth of drawdown before that account is blown. So what you want to do is you obviously don't want to risk a large size of the account where it's going to set yourself up to, if you take 2-3 losses in a row, where you blow the account, or even you're maybe one trade away from blowing the account. And this is how I would approach a actual past funded account as well. So on any given trade, you are going to have a stop loss and obviously a take profit. You guys already know what this is. This is basically a long position box, or whatever you want to call it, where this is the amount you risk and this is the amount of profit you are looking to gain on any given trade. So my approach to risk management is very straightforward. I'm always trying to risk the same amount of actual US dollars on a trade for every trade I take. So going back to this right here, we have $2,000 to $2,500 worth of drawdown that we can play with to make profit, right? So in my opinion, whenever you're trading an account, you should never go above 10% in risk. And I know even this number is high for most people, and most people are going to tell you to risk 2 to 3% per trade. I would say that applies more to a live account. If you're trading on an evaluation or a prop firm funded account, I think that this is the highest you should go if you're funded. I think that with evals, obviously some people are going to want to pass them faster, and they are more comfortable blowing their accounts quicker if they are wrong on trades. That's a risk they are willing to take. But that is not a healthy way to trade. That is not the way you should do it. So really the way I have always approached prop firm accounts is on every trade, I'm risking around 10%, usually just under 10% per trade. So on a 50K account, that's going to be around a $200 risk per trade. So what that does is it allows me to actually have potentially 10 or more, depending on what firm you go with, 10 or more losses in a row before you blow your account. If you're taking 10 losses in a row, there's a chance that you're not trading properly in the first place, right? So if you are trading properly, this is a very reasonable amount of tries to have before you are right, in my opinion. I don't think that there's too many strategies out there that 10 losses in a row is very likely if you are trading a system and if you are actually sticking to your entry criteria. For prop firms, I'm going to just say 10% is acceptable, no more than 10% on a trade. On a live account, I like to go up to 5%. So what this is going to do is, I'm going to write live account right here. If you risk 5% per trade on a live account, that is going to allow you to be wrong 20 times in a row before you blow your account. So this is a very safe number in my opinion. I think 5% on a live account is a very reasonable risk. The industry standard, I would say, you hear a lot of it all the time, is like 2 to 3% per trade. Obviously, if you don't have a lot of money, you're going to have to risk more money to make money, right? Like on $1,000 account, 2% is $20. You know, if we're risking $20, most of the time we're going to be making between 40 to 60, maybe If you're trading, you know, with order flow, you could get up to like possibly even $80 to $100 per trade, and that's fine. But you always want to make sure that you have gas in the tank. You never want to put yourself in a position where you don't know or you're not going to have enough money to trade the next session or even the next week. So these are basically my general risk parameters for the most part. Now, coming back to what I said about risking the same dollar amount per trade, let's go back to the 50K account example. Let's say we're risking $200 per trade on our 50K eval or our 50K funded account. So we're going to risk $200 per trade. Now, sometimes, especially if you're using order flow, which I'm assuming you are if you're watching this video, is you are going to actually be able to get under this dollar amount on a lot of trades. So like for me, the current conditions, I'm not really risking anything more than 4 points per trade. On all of my trades, generally my risk is between 2 to 4 points on ES. And with one single ES mini contract, that is going to equate to $1 to $200 per trade. So let's say I get a trade where I'm only risking 2 points, then my dollar amount of risk is obviously $100. So you see what I mean? Well, so one thing that's very important for your statistics and your overall risk management is risking the same amount generally on every single trade. You don't want to risk $100 to $200 one trade and then risk $400 to $500 on the next trade. That's going to mess up your data over the long run, where say take a trade and you're risking $200, you win it, right? Let's say you make $400, and then the next trade you go and risk $400 and then you lose it. And now you're back to break even, where if you would have just risked the same amount on the first trade, you would be actually up $200 still. So if you're inconsistent with your risk, it's going to be a lot harder for you to recover the profits that you gave away if you take a loss. So like your equity curve is going to be fluctuating like crazy, and if you put yourself into drawdown, it's going to be a lot harder to get out of, especially if now you're going back to your original risk, which was only $200. It's obviously going to take twice the amount of time to get out of drawdown. So always keep your dollar amount as similar as you can. That also brings me to the point where in these current conditions, 2 to 4 points on ES is very acceptable in my opinion for the way that I trade, at least. If things start to get more volatile and the ranges start to widen on a daily basis, this 2 to 4 point risk is going to be too tight in most cases. So what we have to do is we have to actually risk more distance. So maybe instead of 2 to 4 points, maybe it's 4 to 8 points on a trade. But if we stay with the same size, which is one mini, that risk is going to turn into $400 to $800 per trade. We can't afford that with our account balance being at $2,000 or $2,500. And we want to keep our dollar amount consistent. So what we have to do is we actually have to size down to keep that dollar amount consistent. So instead of trading one mini, if we are risking 4 to 8 points on a trade idea, we want to drop it down to 5 micros. And what that's going to allow you to do is now with 5 micros, we are going to have the same amount of risk per trade with a wider stop loss on 5 micros. So we're still going to be getting the same amount of profit, and we're still going to be risking the same amount of US dollars. Instead of our trade looking more like this, it's going to look more like this. And the reason for that is because the ranges are larger now. So if we are still risking 2 to 4 points whenever the ranges get a lot wider and we start expanding, that's going to set us up for disaster. And it's going to lead to taking a lot of paper cuts that are going to add up and eat away at your drawdown. And especially if your stop loss isn't at a point of invalidation. So like it's going to be a lot harder to get your stop loss at a point of invalidation with a 2 to 4 point stop on a market that has crazier ranges than what we're seeing currently at the moment. Whenever market conditions change, this is the most important thing you can do. And at first, it's going to be tough on your psychology because in your head, it's going to feel like you're going to be making less money, but you're not going to be making less money, okay? And this is something that I have struggled with personally. Whenever things start getting volatile, I always have a hard time sizing down because it feels wrong. It feels like I'm going to be making less, and I don't want to make less. Obviously, nobody else wants to make less, right? This is an absolute necessity. Adjusting to the market conditions that are going to change forever. They're always going to change. We're never going to be trading the same way. That is easily one of the most important things I can tell you guys. And sizing down and widening your stops is something that a lot of people struggle with. It feels wrong. It feels like you're going to make less money when you do it, but you're not, because your profit targets are still going to be around the same dollar amount as well. You're always going to be risking $100 to $200 to make, let's say, $400 to $600 on average, maybe even a little bit more than that. So you always want to make sure you keep your dollar amount of risk consistent, or else it is going to mess up your equity curve. And if you get put into drawdown, it is going to make it a lot harder to get out of. So do not change your position sizing. Once you choose how much you're going to risk, stick with it until it's time to size up and you want to start growing. And obviously that is going to be another instance on whenever you have to start taking on more risk. So now we can talk about sizing up. The best way to do this is just to keep the percentages the same. So I'm going to scroll down. So generally on a funded account, 10%, you do not want to go more than that. On a live account, I would recommend everyone to stay below 5%. Obviously, risk is all subjective. Just because I tell you that you should do this, if you want to risk more, go right on ahead. I don't care. It's not my business. It's not my account. I've had accounts where they were very small, and obviously a sizable amount of money, you have to risk more. So there have been times where I had a $500 account and I was risking $100 to $200 per trade, and that's obviously up to 20% of the account, potentially even more. So you have to understand the risk with that, but obviously with a smaller account, you have less to lose, so it makes a little bit more sense. But if you have a $100,000 trading account, risking 10% is very stupid. In my opinion, it is not something that is appropriate to do. If you're trading with $100,000, risking more than $5,000 is just considered high risk. Once again, if you're okay with doing that, go ahead, but I wouldn't recommend it personally. I would say that risking a few $1,000s, I mean, you're gonna make $4,000 to $8,000 from that. So that's obviously a really good amount of money. So I mean, you should be comfortable with that given your $100,000 account size. So I kind of got off track there, but as far as sizing up, the best thing you can do is just make sure you are staying as close to these numbers as you can. So as your account grows, you can slowly start to risk a higher dollar amount based on the percentage it is of your account. So like for a simple example, let's say you have $1,000. So for a very simple example, let's say you have an $1,000 account. I would not risk more than 5% per trade if this was a live account. So we'll say 5% of $1,000 is $50 worth of risk. And with that $50 worth of risk, you're going to be making anywhere from like $150 probably to $200 per trade. Once your account grows, so once you grow your account to $2,000, now your percentage is a lot lower. So now that $50 is what? Only like 2.5% of your account. So if you're going to stick with the 5% rule, you can understand that sizing up now is more appropriate because you're still going to be at that 5% mark. So now let's say you grew it to 2,000. Now it's more acceptable for you to risk $100 per trade to make anywhere from $300 to $400, and so on and so forth. So basically, you're just going to keep adjusting your risk relative to the percentage of your account, and that is the safest way to scale up, because with 5% risk, you're always going to have 20 losses in a row before you blow your account. So basically, keeping your percentage consistent is going to allow you to compound your account. So obviously, as you make more money, you're risking more money, you're making more profits, you're making more money, you're risking more money, and so on and so forth. And that's basically the most intelligent way to grow your account. I'm going to say it once again, risk is subjective. Just because I tell you to risk 5% doesn't mean you have to risk 5%. It is the safer way to do it. It is the smart way to do it. Some people, let's say you come in with $1,000 account and, risking $50 to make $150 to $200 can be great, right? That's a good amount of money for a lot of people too, on a daily basis at least. With a smaller account, I'm going to make the argument that it is more acceptable to put on more risk. So if you have a $1,000 account and you want to risk $100, I still view that as acceptable because although you have 10 tries in a row before that account is depleted, that's still a decent amount of tries before you blow your account. Like, you literally have to lose 10 times in a row. And if you are trading properly, if you're trading a system, there is a high probability, it's not impossible, it's a high probability that you will not do that. But obviously, once again, that is only if you are actually trading properly and trading a system. And obviously this also depends on what system you trade, what your win rate is, and what your win rate to your risk reward is over time. So like, in my case, and probably for most of you guys watching this, if you're trading order flow, I'd be willing to bet that your win rate is going to be anywhere from 35 up to 60% on a really good month. So if your win rate is 35 to 60% on a general average, and you're making anywhere from 3R plus on a trade, meaning you are always making at least 3 times more than you risk, which for me, 3R is a lower end. My average is really around like a 4.2R per trade. So if your average risk to reward on any trade is 3R, meaning you're risking $100 to make $300 on every trade, what that's going to look like is every trade you're going to risk $300, right? Now let's say you lose the first one, you're negative $100. Let's say you lose the second one, you're negative $200 now. But you win the third one. Now you're plus $100 because your one winner made up for both of your losses and more. So this is a profitable system. If you have a 30% win rate or a 33% win rate, and your risk to reward ratio is a 3R, you are going to have a profitable system. If you would have a 2R, it's a little bit different, but let's just do this. So if you have a 2R average risk to reward on a trade, you need your win rate to be 50% to be profitable. So if you lose the first one, that's negative 100. If you win the second one, that's plus 200. Both times you risked $100. Both times you risked $100. So your balance is going to be plus $100. So in a lot of your guys' cases watching this, since you're trading order flow, your win rate is going to be lower and your risk to reward is going to be higher. My average risk to reward across my data is something around 4.2R. As long as I keep my win rate above 25% and even a little bit less than 25%, I am going to have a profitable system. If my win rate is a 3R, I need a 33% win rate to have a profitable system. If I have anything below this, that becomes unprofitable, and that is not a system that you want to trade. So obviously, the better win rate you have, the more profits you're going to make, especially if you keep your risk consistent and you're hitting like 3 to 4Rs. So trading order flow, I like to shoot for anywhere around a 35% to a 50% win rate. This is a really good month. So if I have a 35 to 50% win rate and my average R multiple is a 4R, you guys can imagine that that is a very profitable system. This only happens whenever you actually trade a system and you only stick to high probability setups that make sense and that have actual criteria backing them. If you're taking a bunch of shitty trades, you can obviously assume that you're going to start losing a lot more trades. It's going to mess your win rate up. And especially if you have a lower R multiple, the more trades you lose, the higher your R multiple has to be. The lower your win rate is, the higher your R multiple has to be. So that is a very important thing to keep in mind. Now, like I said, most of you guys watching this trading order flow, we are normally considered to have a lower win rate system, but a higher risk to reward system. But just make sure you guys are understanding these numbers right here. You're shooting for a 2R, you need to be right 50% of the time. If you're shooting for a 3R, you need to be right 33% of the time, or 1/3 of the time. 4R, you need to be right 25% of the time. 5R is obviously 20%, and so on and so forth. So you guys really need to be aware of this, and that is also why it's so important to keep your dollar amount risk consistent. You don't want to change your dollar amount risk unless it's actually smart relative to your account balance. So like, going back to the example, like I said, say you have $1,000 account and your average R multiple is a 2R. You need to be right 50% of the time, or else you are going to be unprofitable. If your risk is not consistent and the first trade you risk 100, you lose 100. The next trade you risk 200 and you lose 200. And then because you lost 200, now you're like, oh, I'm going to go back to my initial risk and I'm going to go back to 100. Let's say you win now. You risked 100 to make $200. Guess what? You're still negative $100. So make sure that you always keep your dollar amount consistent. That is a huge thing that you guys need to stick to no matter what. Once again, if you do want to scale up, make sure it's an appropriate time and make sure you're never going above the actual percentages that you want to keep as your max risk per account. So now I'll talk about some rules that I like to have for myself to keep my risk in check. So always the same amount of dollar risk, no matter what, unless it's time to scale up. Always the same dollar amount per trade, unless it's time to scale up. So the next thing I like to do is I like to limit myself to a dollar amount of risk per day. So for me, it's always 3 trades. So I'll say 3 losses per day is my limit. And I also kind of calculate it in terms of dollar amount. So let's say for this example, I'm risking $100 per trade, never losing more than $300 per day. And this is a super important rule because it's going to keep you in the game longer. If you break this rule and you're still trading bad, the next day you got less money in your account and you have a higher chance of hitting that maximum loss limit. So I always like to have a maximum losses per day, or sometimes a maximum dollar amount. So like, let's say I take 3 trades, but one of them's a break even. If there's a setup that's worth taking, I will give myself another chance to take it, even though I took 3 trades. So technically, I guess it still abides to the rule since it's 3 losses, but normally I like to even say 3 entries, because most of the time, if I'm taking 3 entries and I haven't made a target and I haven't hit a profit target, I'm just in a bad headspace. I'm not trading right. My analysis is incorrect. And it's best to just walk away and preserve the capital and come back the next day or the next week and actually trade properly and get a better mindset to put on winning trades. So these are like my 2 main risk management rules. So another rule I have is if I'm on a losing streak, let's say I've lost 9 times in a row and my account's damn near blown. We'll just say I blew an account, right? I'm not going to come back and trade live capital, or I'm not going to come back and trade another funded account after losing 9 times in a row. If I lose 9 times in a row, I have to take a break. I have to take a break from trading capital or trading funded accounts, and I have to trade paper. I have to get my confidence back. I have to get my mindset back again, because these losses, you don't want to admit it, but they actually do affect your psychology, and they're definitely going to affect your future decision making. So if I'm on a win streak or I blow an account or something, I have to trade paper and I have to develop my confidence once again. So I got to trade paper and I got to get myself back on track before going back to those funded accounts or the live account, whatever it may be. And that's once again going to prevent you from making any bad decisions, and it's going to help you get your psychology back faster and get you back in the game quicker than you would if you were just to keep trading live money or a funded account and just keep fucking up. So those are really my main rules. That's my general risk protocol overall. Hope you guys enjoyed the video. If you're getting value out of this bootcamp, please subscribe, like the video. Order Flow Discord is in the description. It's free, and I'll catch you guys in the next one.